In this video, I'm going to be doing a stock analysis on DocuSign by digging into the fundamentals, financials, and finally determining a fair price to pay for this business. If you're new here, my name is Leo, and my channel is dedicated towards all things investing. Make sure you hit that subscribe button, and anything mentioned in this video will be provided with a link down in the description. So without further ado, and enough stuttering, let's jump into it. So we're loaded up DocuSign on my very own stock research application here. This helps me fundamentally look at companies very quickly and efficiently. So we have our company metrics tab here, our financial evaluation score sheet, which we'll look at afterwards, and finally our price analysis category, which will help dissect this company. Now with DocuSign, I've actually used this quite a bit. I had no idea it was actually a publicly traded company. It's a great piece of software, but even though something's great, let's see how this company is actually performing. Let's jump into the company metrics category here first, folks. And what we'll do is we'll compare where our 5-year numbers are, so kind of gauge where the company's been the last 5 years, and compare that to our trailing 12 months numbers to try to gauge where this company is going to be heading. And let's see if those numbers pop out at us and see if we like what we see. So we don't really have a 5-year number just because this company did, I believe, IPO'd in 2018, so it's at that 4-year mark. So we don't have a 5-year PE average, but we're sitting at a negative 211. Our EPS is negative across the board for 5-year and trailing 12 months. Same with the return on equity, profit margin, and yeah, so negative for at least these 4 main categories here, folks. So not too impressed. Our revenue is sitting at $2 billion. With a net income of negative 69 million, as well as our free cash flow. It's up over our 5-year average, our 5-year average being 157 compared to our trailing 12 months being at $445 million. So that is impressive, but unfortunately that's pretty much the only positive we have here, with our return on invested capital being negative 5.29% and our 5-year average being negative 18%. There's a slight improvement, however, it's not going to earn any points from me. Our Almond Z-score is at 3.86, which we want this to be over 3, folks. That's just it just determines the risk of bankruptcy with the company. So it's saying that it's, I guess, relatively safe. But our Pietrowski score, we want this to be between 7 and 9, 9 being the highest score you can possibly get. And we're sitting at a 5. This is a very mediocre score to get. I would even argue on the low end. So right off the bat, looking at DocuSign, I gotta say I'm not too impressed right at the moment, folks, just because of the negative numbers that we had across the board. Now, granted, it is a fairly new company. It's been on the market for 4 years, but 5 years is that sweet spot for me, and we're approaching that. So that's something I would like to see of, at least some sort of improvement. But as you can see here, we're seeing a massive run up in price to the point where we've hit $314. And that's in the last 52-week range. And now we're sitting at the $75 close. Quite the big drop. So with the company metrics category done, I gotta say I'm not too thrilled. We're gonna go into our financial evaluations category here, folks. So this is our list here. We're scoring this 2 out of 10. Which is absolutely horrible. And the reason why it's getting 2 out of 10 is because the only categories where it's scoring points are in the 5-year free cash flow increase, because there is a growth as we expressed, and there's revenue growth over the last 5 years. However, it's not going to get points in a lot of key areas. One being the current ratio here, folks. We want this to be over 1.5, and it's at 0.96. That just indicates to me that they have a lot of liabilities on hand and not enough assets to cover those liabilities in case things went wrong. So that is somewhat, well, not somewhat, but very concerning. Our 5-year PE average, I'm going to just say it's a 0. Granted, we don't have that number because the company hasn't been around for 5 years, and typically I like to evaluate companies that have been. So it's going to get a 0 because just based off this number here, from our company metrics side, we're sitting at a negative 211 PE ratio. This company is not generating essentially any money. And just to go back to our financial valuations category, return on equity, we want this to be over 15%. We don't have that, so no points there. EPS growth, there hasn't been growth in the EPS. Debt to equity, we're sitting at 300%, folks. We want this number to be below 50%. We want them to be growing their, growing their capital or leveraging their capital through equity within the business and not taking on debt. So what that indicates to me is they're taking on a lot of debt to grow the business. That's absolutely terrible. We don't like to see that. Moving on to our share dilution, we're seeing that at a 6.37% increase over the last 4 years, essentially. And what that indicates is that the company is diluting you with shares, and we want to see them taking away shares so that you can own more ownership of the business. So it's not a huge increase in shares, but it's an increase nonetheless. We don't want that. We want shares staying the same in terms of quantity or decreasing. And I mean, it makes sense that they were issuing shares. This huge run up in price over the last, since 2020, the last couple of years. Why not? You know what? People like buying the stock. It only makes sense for the company to issue more stock to the shareholders. They're going to eat it up anyways. We talked about our free cash flow growth, so we know where we stand with that. Return on invested capital average, we want this to be over 10%, 10% or higher, and we're sitting at negative 18.56%, folks. That is absolutely horrendous. So what this shows me is DocuSign just is unable to make money over the last 4 years. So that being said, it's going to be really hard to do a price analysis on this because, this negative PE ratio, we have to try to determine, a metric of where they'd be profitable. Let's jump into our price analysis and try to gauge where this business, or at least what a fair price to pay for this business would be. And as I said, negative profit margin is going to definitely hurt us a lot because now we have to try to make at least a speculation of what would be the profit margin or what would this company look like if it were profitable. So we'll do a 10-year evaluation. I don't think it's going to continue growing at the rate it has been, but I will be obviously conservative as much as possible with still being somewhat lenient. So we're going to do 30% revenue growth. Actually, you know what? Let's do 25 on the low end. We'll do 30 on the moderate side, and then we'll do 35 on the aggressive side. Now, those are some obscure numbers, but over the next 10 years, it very well could happen, right? Now, with our profit margin, I'm going to just spin this around and go with a 15% profit margin. We'll do 20, and then we can do 24. Free cash flow margin, we have 21.12 and 11. Okay, so 11% and 21%. I'm going to hover around the 5-year number here, folks. We'll do 9, 10, and 11. Price to free cash flow, we're going to go on our conservative higher estimate numbers here. I always like to do like a 14, 16, 18. And then a PE ratio. See, now here's where the guessing work comes in, folks. We're going to go 14, 16, 18, and then we'll do our desired return of being 13%. And as expected, it's going to show that it's going to be a buy all day. We hit green across the board. Now, the major flaw with this price analysis is that half of these numbers don't exist. We don't have a profit margin. We don't have a PE ratio that's positive. So we're assuming that they would hit these profit margins. We should do something a little bit more conservative. If I do like let's say a 2% profit margin. Let's say they just started making money, and then we could do 10, and then followed in by not 105. That'd be absolutely insane. 15% profit margin. We're showing a buy on the moderate and an aggressive side, and an average calculation of being $202. My main thing is, from a fundamental perspective, is these numbers before I even think about like deals and whatnot, like I don't really care about that nonsense. It's what's in front of me that matters. That's my main like objective. When can this company be profitable would be my first question, or when is it going to be when is it going to be profitable, and when is it going to cover a lot of its debt? These are the two biggest problems that I have with this business, is that there's a lot of liabilities on hand and they're growing the business from a huge debt perspective. Now, granted, if you believe these numbers here and you believe they're going to be profitable tomorrow, you know what? It may be a buy in your books. To me, I'm avoiding this company like the plague until I see this number at least at a 1.5 and debt to equity at that 50% mark. I don't know how people could have justified buying it at this price all the way up here at 300, what was it, 314, $300? Like, doesn't make sense to me, folks. If you enjoyed the video up until this point, folks, make sure you hit the like button and the subscribe button. It means a lot to me. It helps out the channel a lot. Makes me feel warm and fuzzy inside. So, like button, subscribe button, the 1-2 punch combo. Make sure you do one of that, do one of those, do one of that, do one of those. I don't know what I'm talking about. A lot of gibberish. My closing thoughts on DocuSign is simply this. The business has a lot of hurdles to get through before I can justify opening up a position. Right now, my price analysis, as I said probably numerous times in this video, is a lot of speculating because there are numbers that simply just don't exist. I'm speculating a PE ratio that is way off from what it's currently being reported, as well as a profit margin that hasn't existed at all. We're negative 22 on the 5-year side and negative 3 on the 1-year side. I need this to be somewhat positive for the next couple of years to try to at least gauge, okay, you know what, this is where it might be. But more importantly, it's the debt. It's the current ratio being at 0.96%. It's the debt to equity being at 306% that it really throws me off. These are numbers here that are going to cripple this business if it doesn't, get it under control. And they're diluting you with shares. So they're expecting you, the shareholder, to cover those numbers. I don't know. I'm avoiding it. You do what you want with this information. It's all entertainment. It's not financial advice. You have to do your own due diligence. But those are my thoughts, guys. Thank you so much for watching. Leave a comment down below of what your thoughts on DocuSign are. If you own the business, if you believe these numbers that I put in. And yeah, I'll make a follow-up video with this company in the next few months. Definitely once they start making money. I'm going to keep it at least a keen eye on it. So yeah, that's the video. I'll stop mumble jumbling. Thank you for watching. See you in the next one.